Nithin Kamath wrote in a post on X that this will be the death of currency derivative trading on stock exchanges by retail traders and that regulatory risk is the biggest risk for stockbrokers. What made him say so? Stay tuned to know everything on this topic. This is Stocky. So what is this all about? Let us know. Firstly, few days back the news released was that the Reserve Bank of India, RBI, imposed limitations on the use of exchange-traded currency derivatives, ETCD, provided by both NSE and BSE specifically for hedging purposes. Now, let us divide it in parts and understand what exactly it is. First, let us understand what is currency derivatives, or ETCD. Currency derivatives or exchange-traded currency, Forex, derivatives or ETCD are like agreements to buy or sell foreign currency at a set price on a specific date, but traded on official platforms like stock exchanges. They're used for managing currency risk or making bets on currency movements in a regulated market. Coming back to our main topic, the reason Zerodha mentioned this is that the Reserve Bank of India, RBI, introduced new norms that require traders to close their FX derivatives positions by April 5, leading Zerodha, a popular trading platform, to notify its clients about this. The founder of Zerodha, Nithin Kamath, believes that this move will essentially end currency derivative trading for retail traders on stock exchanges. The aim behind these regulations is to reduce currency volatility, especially as foreign funds have been flowing into the nation's bond markets. The RBI has been accumulating Forex reserves to protect against external shocks and uses various currency platforms to intervene in the market. However, experts predict that this new requirement will significantly reduce trading volumes in currency derivatives. Now, what are these new norms? Well, here is a list. To trade currency derivatives on the stock exchange, traders are required to have currency exposure, in line with RBI regulations. Zerodha advises closing open positions by April 5 to adhere to RBI guidelines. Starting April 4, users can close existing positions but must provide a declaration to initiate new ones. Traders with exposures exceeding $100 million must designate a custodian participant or authorized dealer. For those with smaller exposures, a simple declaration suffices to trade currency as a hedge against contracted exposure. Failure to furnish this declaration prohibits initiating new positions from April 4, although exiting positions remains permissible. It is recommended to closely monitor open positions as liquidity may diminish before April 5, when the RBI circular becomes effective. According to RBI guidelines, contracted exposure refers to currency risk from permissible transactions under FEMA, 1999. An update on the previous news was released few hours back, which says that the Reserve Bank of India, RBI, has postponed the implementation of new rules for exchange-traded Forex derivatives to May 3, which were originally set to come into effect today. These rules aim to require participants to have an actual foreign exchange exposure, leading to concerns about reduced trading volumes in the market. Brokerages have already begun advising clients to close out contracts to comply with the new regulations. Zerodha, for instance, instructed traders to close open positions by April 5. The move is expected to impact individual traders and speculators, who make up a significant portion of the market's volume. The rule aligns with the RBI's broader Forex management policy to reduce volatility in the rupee, particularly ahead of the nation's bond market inclusion in global indexes from June. So, participants get more time to close their positions now. So, folks, stay updated on things going around you for your own good. That's all for today. Stay tuned for more and subscribe to my channel if not done yet. See you next time. Till then, be informed, happy trading, and keep learning.